George, thank you so much for joining us here at CAIS20.
Thank you.
You've probably seen the key themes this year are global, digital, responsible. Which would you see as the priority, and which of those do you regard as most important in this environment?
Well, as quantitative systematic managers at PanAgora, I think what we do is we take the digital and apply it to the global and the responsible. So, on the responsible side, we are pushing fast ahead in the ESG world. I think it's an integral part of our investment process. It drives a lot of our investment decisions, and we're able to cull data, which is very messy and hard to find right now, but that's what we're good at, and use it to implement in our investment process.
Because finding those measures in that environment is quite key, isn't it?
Yeah, I mean, it's I think there's a lot of different data providers that are kind of disagreeing right now on which company is the best environmental or governance-wise. But we take a different view on it. We're looking at sitting around the table and asking ourselves, what are the characteristics of companies that will succeed in the future? So that conversation has changed over the decades, right? If you look at the transition of companies around the world, 20, 30 years ago, they were very heavy in plant property equipment, right? The behemoths were General Motors, Exxon, and as long as they were producing good ROEs and profit margins, you could just look at their balance sheets and decide which companies were going to succeed. But look at the companies of today, right? It's Amazon, Microsoft, Facebook, huge market caps, but if you looked at their balance sheets, they're actually very slim, right? So where is the value created? It's in things like intellectual property, brand strength, the way they treat their employees, right? So it's come off the balance sheet and income statement into these intangibles, right?
You talked there about the way you treat a workforce. That's going to become one of those new measures, isn't it? And part of that ESG success.
Right, and I think that's what's changed over the years is, 5, 10 years ago, there was no way of measuring that. If you listen to the CEO, every CEO says that they have wonderful employees that are happy. But now we have tools to go right in to see what the employees are actually saying, right? There's a lot of websites around the world in different countries that offer a platform for employees to go on, talk about what it's like to work at the company. Do they approve of CEO performance? And with our technological prowess, we can go in, scrape all that data, analyze it using natural language processing, and really understand which companies are the best places to work.
So with all of that in mind, do you think this industry now has the tools it needs, has no more excuses anymore, it can be a crucial player in improving environment and looking at the big climate question, because it has both the financial clout, it has the data expertise, and it's in the best position to do that? Yeah,
as our CEO, Eric Sorensen, veteran in the quant industry, said recently, he believes quants are going to own ESG, and I think it's for those reasons. It is very noisy and messy, and it's hard for fundamental analysts to cull through all that. But with strong data techniques, we can go. We're not going to wait for the kind of ESG data landscape to clear up. We're going to dive right in and figure out how to build the best models today.
And on the most basic level, humans need those hard numbers, the hard facts. When you've got a President Trump telling people that climate change doesn't exist,
right.
Those facts and figures are going to drive change.
Yeah, and I think another thing we've been working with our clients on is, we have our drivers of return modeled kind of in an optimal way, but a lot of clients come to us with their own requests, right? European pensions are very interested in carbon emission. A lot of plans in the US are looking at diversity in the workplace. That might not be a pure kind of alpha signal, but we know it's important to the client. So what we can do is, through our ESG framework, we can talk to them and discuss a efficient frontier, right, which we build for each client. We discuss, the impact of their decisions on the performance. Adding a little carbon emission constraint might not impact performance much, but putting a huge burden on the portfolio is going to hurt performance. And we know that they have another requirement is to provide the returns they need for their pensioners and retirees. So we work together with them to get the best solution.
And do you truly believe we are seeing that action now? Because there's been a lot of talk for the past 5 or 6 years. Is there still that gap between the say and the do?
Well, I think it depends. You have to really look manager to manager. We don't put anything in our model unless we have 100% conviction that this really improves performance. And a lot of the things that we're seeing are also help at performance, but also meet kind of ESG requirements. I do see that sometimes managers feel forced to include some of these. They might go to third-party metrics and kind of just add some exposure to some of these. That's not really adding alpha, but it might just be fulfilling the requirements of
ticking a box.
Yeah.
Well, let's hope we do see real action, and actually a conference like this that brings it to the fore and triggers those conversations is going to be useful. There's some fantastic panels here. What have you enjoyed most about being at CAIS?
Yeah, I mean, we've heard a lot of great panelists and speakers, and I think just the coming together of these three themes is very interesting to see.
Well, thank you so much for joining us. It's been great to talk to you.